All right, welcome to This Explainer. Look, if you've ever glanced at a financial news headline and just felt your eyes immediately glaze over at the absolute alphabet soup of banking acronyms, you are in exactly the right place. Today, we are decoding the single most watched profitability metric in the entire banking sector. We're talking about NIM, and we're going to build your intuition for this from the ground up, completely jargon-free, before we layer on the real professional analyst toolkit.
Because to really understand this massive trillion-dollar global industry, we've got to start by asking the simplest, most fundamental question possible. How does a bank actually make its money? Honestly, it is so easy to get totally lost in the weeds of global financial systems and derivatives and algorithmic trading. But to really grasp the core engine of a bank, we need to zoom way, way out from Wall Street or Dallas Street. Let's take it all the way down to a super relatable neighborhood scenario. I want you to imagine you're a kid again, and you're setting up a little business right on your front lawn.
Okay, let's break down the basic lemonade stand math. You want to sell lemonade, right? But you literally have zero money. So what do? You borrow $100 from a friend, and they charge you a 5 rupee fee for the favor. You take that 100, you buy your lemons, you buy your sugar, you make the lemonade, and boom, you sell it all for 120 rupees. So out of that 120, you made $20 over your initial 100. But wait, you've got to pay back your friend's 5 rupee fee. So you keep 15. That 15 rupees you get to keep, out of the 100 you cycle through your little stand, that is your raw margin.
And honestly, this brilliantly illustrates the entire foundation of modern banking. A bank is quite literally just a giant, heavily regulated version of this exact same lemonade stand. They borrow money from depositors, so that's your friend lending you the $100, and they pay a cost for holding that money. Then they turn around and lend that money out to borrowers, which is you selling the lemonade, and they do it at a higher interest rate. The difference between what they earn from lending and what they pay for borrowing is exactly like that 15 rupees you kept. That spread is the core engine running their whole business model.
Okay, so now let's bring in the actual industry jargon, net interest margin, or NIM. The net part, that's simply your interest earned minus your interest paid, just like our lemonade stand math. But NIM expresses this margin as a percentage of a bank's interest earning assets. And you might be wondering, well, why a percentage instead of just a raw rupee amount? Well, because it levels the playing field. It lets us fairly compare the core profitability of a colossal giant like SBI directly against a tiny, specialized small finance bank.
So really, NIM is essentially a massive tug of war. Over on one end, we have the yield on advances. That's simply the average interest rate the bank charges its borrowers, the folks taking out home loans or car loans or huge corporate debt. That is the money coming in. On the other end of the rope, we have the cost of funds, or cost of deposits. This is the average rate the bank pays out to people like you and me, just for keeping our money parked in their savings accounts or fixed deposits. That's money going out. The gap between those two numbers, that creates the raw spread. So to make that margin wider, a bank basically has two choices: charge borrowers more or pay depositors less.
Now, obviously, in a super competitive market, a bank can't just wildly hike up the interest rates it charges borrowers, right? Because those borrowers will just walk straight over to a rival bank. So the real magic actually happens on the other side of the equation. How do you push your cost of funds down? Well, our source document actually calls this secret weapon the single biggest lever behind a strong spread. So let's uncover what that lever actually is.
That secret lever? It's CASA, the current account and savings account ratio. Think back to our lemonade stand for a second. If your aunt gives you some coins to hold on to safely and she doesn't ask for any extra money in return, well, that is incredibly cheap funding for you. In the banking world, current accounts pay zero interest and savings accounts pay very, very low interest. So the higher a bank's share of these friendly, cheap CASA deposits compared to expensive, locked-in fixed deposits, the significantly lower their overall cost of funds will be. And just like the math dictates, a high CASA ratio directly drives a low cost of funds, which directly results in a wider, much more profitable NIM.
So how does this actually look out there in the real world across different institutions? Well, public sector or PSU banks generally hover around a 3% margin. Private banks typically operate a bit higher, usually pushing somewhere between 3.5% and 4.3%. But look at small finance banks, or SFBs. They boast dramatically higher margins, often sitting way up between 6% and 8%. Now, on the surface, if NIM is the ultimate profitability metric, you might look at this and assume SFBs are just vastly superior, runaway money-making machines that everyone should be investing in over a PSU, right?
But, and this is a big but, here is where we have to apply our critical analyst lens. Higher is not always safer. A massive NIM isn't just a high score in a video game. It actually tells a whole story about the bank's underlying strategy.
Those small finance banks earn those incredibly high 6 to 8% margins precisely because they are lending to much riskier borrowers. To get that high yield on advances, they're handing out loans to people or small businesses that bigger banks might just flat out reject. So yes, the margin is way wider, but the risk of those loans going bad and turning into non-performing assets, the kids who chug your lemonade and never actually pay you back, that risk is significantly higher. That high NIM, it's basically a premium charged for taking on a ton of extra risk.
Now, we also have to factor in the master dial for all of this, the RBI repo rate. When the central bank cuts rates, you'd probably think, hey, cheap money, that's got to be great for banks. But it actually ends up squeezing their net interest margins. Why? It all comes down to timing. When rates fall, the floating rate loans they've handed out, well, those instantly become cheaper for borrowers, so the bank's income takes a fast hit. But the fixed deposits they owe to customers, those stay locked in at the old, higher rates for a while. So long story short, their income drops way before their costs do.
All right, one last thing, and this is absolutely crucial if you're digging into quarterly earnings reports. There is a vital difference between reported NIM and core NIM. When a bank splashes its headline NIM number everywhere, that reported NIM often includes messy, one-off events. We're talking sudden interest earned on a random old tax refund or unexpected income recovered from a loan they thought was totally dead years ago. Core NIM, however, strips all of that noise out. It takes away the flukes and the one-offs to show you the clean, true underlying margin of the bank's actual day-to-day lending operations. Core NIM is the honest engine of the lemonade stand, before you count the random coin you happen to find on the sidewalk that morning.
So, I'm going to leave you with this thought to carry into your next financial deep dive. Armed with this knowledge, you are no longer just a passive consumer of headlines. The next time a major bank flashes across your feed reporting absolute record-breaking profits, what are you going to do? Will you just swallow that raw reported number at face value? Or are you going to dig into their CASA ratio and demand to see their true, clean core margin to find out if the engine is actually running smoothly? The choice is totally yours. Thanks for joining me on this explainer, and remember, keep asking the right questions.